Well, good morning and hello. It's me, Kenny Polcari, your host of the party, and today is Tuesday, June 4th, 2024. And here are the things you need to know. Well, let's start with the weather. Looks kind of nice out there. Blue kind of over here, cloudy over there, not really sure. We're going to go up, we're going to go down today. I'll see if the weather gives us any hint. In the meantime, here are the things that you need to know to get your day started. So the eco data yesterday is suggesting a slowdown. So is bad news now bad news for the markets, considering we kind of saw some pressure yesterday? We got two PMIs, both showing different results. How do we know which one to really listen to? I mean, they both measure the same thing, right? So is it value or growth? What do you do now in your portfolio? Oil's down, gold is up, bonds are up, and yields are down based on the economic data that we got yesterday. And what do we have at dinner tonight? We're going to have the roasted pork loin with peaches and honey. Simple to make. It's so sweet and delicious. Okay, so the week yesterday started on a downbeat, right? Economic data continues to be mixed, but they focused on the weaker parts to tell the story of a slowing economy in need of a rate cut. So you ask, well, then if they're going to cut rates, stocks should have rallied on that idea. No, lower rates, good for stocks. Well, maybe not so much this time. Why? Because this is when the bad news is actually bad news for the markets and for the economy versus those times when bad news is good news, right, for stocks, which has been the story for actually a fairly decent amount of time. Now, recall that yesterday we were getting a handful of economic reports, the focus being the latest PMIs, right, the Purchasing Managers Index reports, and the ISM prices paid, and ISM new orders, and ISM employment. Well, here are the details. First, we had the S&P U.S. manufacturing PMI. It came in at 51.3, well above the estimate of 50.9, suggesting expansion. Recall 50 is a dividing line. That was the positive, right? But then we get the ISM manufacturing PMI, and that came in at 48.7, well below the dividing line and well below the estimate of 49.5, which was already weak. So that's the negative. Okay, so now we get these two measures of PMI, both pointing in different directions. One says we're expanding, the other one says, not so fast, we're contracting. So which one do you pay attention to? I mean, you can, if you want to be positive, you're going to pay attention to the S&P. You want to be negative, you're going to be the ISM. So here's what you have to do first. You have to understand the differences between the two and the methodologies that they use. S&P is a private global company. It surveys a broad range of manufacturers across the U.S., including small and medium-sized businesses. ISM is a professional association for purchasing managers. It primarily surveys larger U.S. manufacturers, likely skewing the results towards these bigger companies. S&P uses a methodology that allows for direct comparisons to other countries, while the ISM is tailored to reflect only the U.S. specifically. S&P uses 5 major components and weights them according to their contribution to the equation, while ISM uses 5 components but weights them equally, giving none an advantage. S&P has an international orientation, while the ISM focuses really on the U.S. only. Then we get the ISM prices paid, and that also showed a decline, which is a good thing, right? Declining prices means inflation should be subsiding. Just another reason to cut rates. And then there was the ISM new orders, and this reflects new orders, right? It is a key indicator of future production and economic health. So a declining number here suggests potential trouble ahead. New orders were expected to come in at 49.4, but came in at 45.4. Again, well below 50, which is the neutral line, and well below the expectation. And so now you know why the markets and the algos paid attention to the weaker ISM results. First, it's U.S. focused, and second, because it supports the narrative of a slowing U.S. economy, and that is in need of help, and think about rate cuts. The slowing economy caused by a restrictive Fed and higher interest rates, right? That's a negative. The Dow Industrials ended up giving up 115 points, but they were down more than 400 midday. The S&P gained 6 points, and the NASDAQ gained 94 points, right? You could thank NVIDIA. The Russell, which was up 25 points in the pre-markets prior to the data releases, ended the day down 10 points. The Dow Transports lost 163, while the equal-weighted S&P gave up 35 points. Bonds once again rallied on this news. The TLT was up 1.3%, the TLH up 0.8%, while the Ag Index, right, which includes both corporates and treasuries, was up 0.3%. The 2-year yields fell to 4.79%. 4.4%. The 10-year fell to 4.37. Remember, the 2-year was kissing 5% 2 weeks ago, while the 10-year was kissing 4.7% 2 weeks ago. The weaker ISM report most likely starting to make the computers, right, think the algos, nervous. Many street strategists now suggesting that weaker prices is a bad thing, that it's just another example of a weakening economy. Remember, the algos react to how they're programmed. They react to mathematical models, unable to really decipher the fine print or interpret the tone of the language. And you could argue that there is some biases by the people who program those algos, causing those sometimes irrational reactions in the markets, like when we see them all run for the door at the same time, only to all run right back in a day or two later, right? As the data changes. Which is why you need the plan and why you need to understand the long-term investing is a game of patience and opportunity. If you own a portfolio of large mega caps names that are titans in the industries that they represent with an appropriate risk score, then you would be less panicked versus owning a portfolio of smaller, lesser capitalized names that put you further out on the risk scale, creating more volatility in your returns and causing you not to be able to sleep at night, right? Because you want to be able to sleep at night. The constant in and out destroying your long-term performance. Remember, your long-term portfolio is just that. It's focused on the long term, riding out the waves, right? Only changing course if the fundamentals change. Now look, tech, which underperformed on Friday, gained on Monday, right? It was up 0.25%, leaving it up 9.5% year to date. But it was healthcare that was the day's winner, up 0.7, leaving that one up 6% year to date, followed by communications up 0.4, leaving that up 15% year to date. The other S&P sectors were in retreat. Energy down 2.6%, but still up 8.2% year to date, based on the latest OPEC plus news, which we talked about, right? Industrials were down 1.2%, but still up 7% on the year. Utilities down 1%, still up 13.5% on the year. Financials down 0.6, but still up 10% on the year. Consumer staples and consumer discretionary down 0.5%, but still up 7.5% and down 1.6% year to date, respectively. The value trade, the SPYV, which was a beneficiary of Friday, came under pressure on Monday, right? It was up 5.6, but it's still up 5.6% year to date. Again, that makes zero sense to me. The value sector is a place you would want to be if you own stocks and are concerned about an economic slowdown. Value stocks are typically defined by low PE ratios, high dividend yields, solid fundamentals, stable earnings, lower volatility, defensive sectors, and attractive valuations. Thus, the name value trade. The growth trade, the SPYG, was up 0.7%. It's up 15.5% year to date. But owning growth stocks can be a challenge if you believe the economy is slowing, right? Earnings are volatile, PEs are high, access to capital becomes more difficult, and consumer business spending usually goes into austerity mode if we go off the edge. So if they're saying that the economic data suggests a weakening economy, we should have seen the growth trade be weaker. But also remember, the growth trade includes and is really now all about AI and the newest industrial technological revolution, which is still very much in its infancy. So this time, it just might be a little bit different, which speaks again to having a well-diversified portfolio, and that includes tech. How much of it is going to include who you are individually. You just need to decide how much exposure you want. You have to do what you have to do, right? You have to decide what your risk tolerance is, what your time horizon is, what your obligations are, what are your current state of employment or not. Do you have kids? Do you have grandchildren? Who are you looking to provide for? And does that change your time frame and perspective? Are you leaving your wealth to charity? I mean, I could go on and on, but you get it, right? There's a lot that goes into any one decision, so making a decision on one single factor is probably not the right thing to do. In any event, the focus is now squarely on the labor market. Friday's NFP report, which includes unemployment, average hourly earnings, both month-over-month and year-over-year, along with changes in manufacturing employment, which means less to me since we're a services economy. Next week, we're going to get PPI and CPI. We're also going to get the June FOMC meeting, which begins on Tuesday, which means as of today, we're in the blackout period, right? FOMC members, Fed members that are on the FOMC committee are now prohibited from talking to the media until next week. But that doesn't mean that the non-members have to keep quiet. So look for anything from Neil Kashkari, because he seems to be the mouthpiece for when the others can't speak. They always send Neil Kashkari out to, conquer the world. You can also watch for comments and stories from Nikki T of the Wall Street Journal or our friends there at Goldman, who also are sources of leaks by the Fed when the Fed wants to float a balloon or an idea to see how the market reacts. They go to Nikki T, they go to Goldman, they go to Nili Kashkari. Now, for now, no one expects a change in policy next week. Rates to remain unchanged, although there are a few that are expecting a change. I think it's way too early. But you can bet that many are expecting JJ to change the tone of his speech, become maybe less hawkish and more dovish. Remember, there are some that are now back into the June rate cut, like I just said, which I think is very premature, while others have moved from the December cut back to September, and others are firmly planted in July. I remain planted in 2025, the first quarter of 2025. I still don't see a 2024 rate cut because inflation is still well above the 2% target. Now, if they change the target, then I guess all bets are off. But if they don't, then I'm good hanging out in 2025. The VIX surged by 10% by lunchtime yesterday as the Dow was plunging, only to end the day up 1.5% after the Dow settled down. This morning, the VIX is up 6.3% in pre-market trading, suggesting building fear once again. Futures turned from flat to lower. Dow futures are now down about 200 points. S&P's down 28, NASDAQ down about 80 points, and the Russell is down 15. Investors have had 24 hours to reconsider the data, and the commentary continues to push concerns over the health of the U.S. economy and slowing factory activity, the slowest in 2 years. Now, today, notice how they're doing that. Today, slowest is being used as a negative, when last week, slowest was used as a positive when describing the pace of inflation in the PCE report when they said it rose at the slowest pace in 2 years. It's funny how that works, right? Oil continues to be under pressure after OPEC Plus said they would continue the production cuts for some of its members, think Saudi and Russia, while possibly allowing increases for the other members starting as early as October. And all this is doing is raising the oversupply concerns, no matter that demand is expected to continue to grow through at least 2025. The U.S. is going to release inventory results tomorrow, and we're going to be able to find out just how much gasoline was consumed over the Memorial Day weekend. West Texas Intermediate was down 3.9% yesterday, and it's down another 2% this morning, leaving oil trading at $72.80 a barrel, well below all the trend lines, right? This is down $4 from Friday's close. 70 is now the target. It just is. The momentum is going to take us there, right? Representing the lows of December, January, and February. So it's got to hold there. Now, if we break 70, then watch, 65 is going to come even faster than that. And then you can expect the Saudis are going to call for an emergency meeting as they change the narrative to try and stop the bleed, right? Because remember, they want to see oil at 80 plus, not at 65 or 70. Gold shot up by $25 yesterday at 1.6%. Think the safety trade. Fear of a slowing economy causing those algos that moved out of the safety trade on Friday and into equities, right back out of equities and back into the safety trade. See how that happens? How the algos, they have this irrational movement, right? This morning, gold is off by $17, trading right back at the trend line as it struggles for direction. Weaker data suggesting a slowing economy is going to see gold hold steady or move higher. I think we remain in the 23-2400 trading range for a while. Eco data today includes the JOLTS report, openings of 8.35 million. Factory orders expected to be up 0.6, which doesn't make sense according to yesterday's week results, although it would be down from last month's plus 1.6%. Durable goods of up 0.7, capital goods orders and shipped of up 0.4 and up 0.3% respectively, both in line with last month. European stocks are weaker because that seems to be the story. Weakness across the globe. Spain down 1.5, Italy down 1.3, Germany down 1.2, Euro stocks down 1.1, right? UK's down 0.5%. Now the ECB is expected to announce a rate cut on Thursday, but the higher than expected Eurozone inflation report that we got last week is now causing concerns that may not happen. Germany is expected to release unemployment figures later this morning, and we'll see what that does to the overall sentiment. The S&P closed yesterday at 52.83, up 6 points. Yesterday, I thought we were about to test the May 23rd high of 53.40, so I guess I was wrong on that, but I wasn't expecting the much weaker ISM report and the resulting reaction. The tone right now is negative, thus the pressure on the markets today and this morning in the futures, right? If you're putting money to work today, let it come to you. There's no need to reach and take. Let the sellers hit your bid. Buy stock on down ticks. Be patient. Call me to discuss the long-term game plan because You know me, I'm always happy to discuss it, and I think it's always important to discuss it. Okay, so what do we have for dinner tonight? So this is a simple dish. You need a pork loin, which you can buy, at the local grocery store. You can go to your, Italian market or wherever. You just want the roasted, you want the pork loin, right? Unseasoned, just the plain pork loin. You want to buy peaches. You can buy peaches in the can, peaches in the jar with the syrup in it, and then you want some honey. You need some. So you need a 3-pound boneless pork loin. You need the peaches, the honey. You need fresh lemon juice. You need brown sugar, and you need salt and pepper. You want to preheat the oven to 400 degrees so that it's ready when you need it. Season the loin with salt and pepper, nothing more. Massage the salt and pepper into it. Maybe use a little bit of olive oil on the loin just to help you massage the salt and pepper into the loin. Place the loin in a roasting pan and then place it in the oven uncovered and let it roast for 30 minutes. Now, in a saucepan on the stove, you're going to add the canned peaches, you're going to add the juice, you're going to add the juice of 2 fresh lemons, you're going to take 2 tablespoons of honey and a half a cup of brown sugar, you're going to put it all in the pot, stir it around, bring it to a boil, and then crush the peaches with the back of the spoon, or even take one of those, one of the macerators and just crush them all up. Cook for maybe 4 or 5 minutes, that's all you need. And then you're going to remove it and put it on the side. After 30 minutes, after the loin has cooked for 30 minutes, you're going to take it out. You're going to pour the peaches in the baking dish over all the loin. Return it to the oven and cook it for maybe another 15 or 20 minutes. Cut it open. You can turn the loin if you want. But when it's done, you want to remove it, slice it to make sure it's cooked, and then let it rest for 5 minutes. Now, slice it like this. Place it on a plate, fan it out, and pour the juice over the top. Serve this with your favorite vegetable. I had roasted cauliflower and a large mixed salad. That's really all it takes. You don't have to make it any more complicated than that. It's a simple dinner to prepare if you come home midweek. Just have everything in your house ready to go. You can have the whole thing done in an hour. So by the time you get home, you put it all in the oven, you go get changed, you come back, you set the table, bang, you're all done. In any event, here we are, it's Tuesday. It's going to be a very interesting day. Until tomorrow, take good care.